A sudden decision by a group of oil-producing nations, known as OPEC, has shaken up the global market by cutting back on oil production. This reduction means there's less oil available, which in turn pushes prices higher, much like how a rare treat becomes more expensive when it's hard to find. This move is a strategic effort by these nations to safeguard their own interests, and its ripple effects are already making everyday life more expensive for many. As a result, higher oil prices have started to affect the United States, where rising costs mean that everything from fueling cars to shipping products is becoming pricier. This increase in costs is placing extra pressure on families and businesses alike. Some experts worry that if this trend continues, it could trigger a broader economic slowdown or even lead to a recession. In response to these challenges, the U.S. is turning to its own resources, notably shale oil. The United States has tapped into its vast shale oil reserves, which has allowed for record-high production levels. However, this strategy isn't without its challenges, as extracting shale oil is more expensive than conventional methods. If oil prices fall, this approach might not be sustainable, adding further uncertainty to the situation. Meanwhile, another significant shift is taking place with the rise of electric vehicles. As millions of electric cars are expected to hit the road soon, many countries are planning to phase out traditional gasoline-powered vehicles. This shift could lead to a decrease in oil demand over time, forcing oil companies to rethink and adjust their strategies. At the same time, Canada is facing its own set of challenges in the world of trade. Historically, Canada and the U.S. have enjoyed a close trading relationship, but recent U.S. policies, like high tariffs on certain goods, have strained this bond. Industries such as steel, aluminum, and dairy have been hit hard, prompting Canada to explore new trade partnerships with regions like the European Union and the United Kingdom. This move is part of Canada's effort to reduce its dependence on the U.S. Canada is exploring new ways to grow its economy, and one idea is a project called canzuk. This plan brings together Canada, the UK, Australia, and New Zealand into one big trading group where goods move freely without extra taxes, and people can work across borders with ease. With many things in common like language and law, this group could offer Canada more economic stability. Still, the big question is whether this new team can really stand up to the strong pull of its longtime partner, the United States. At the same time, Canada isn't turning its back on the US. In fact, it's working on spreading its economic ties to avoid being too dependent on one neighbor. For example, deals like the one with the European Union have already opened up a market of 500 million consumers, making it easier for Canada to export goods to Europe. By adding canzuk to its list of partners, Canada hopes to balance its trade and be more secure if things get rocky with the US. Speaking of the United States, things on the energy front have taken a surprising twist. Not long ago, American leaders said they didn't really need oil from Canada. But now, the US is rushing to restart the Keystone XL pipeline, a project that had been paused over environmental and political worries. This pipeline would bring oil from Canada deep into American refineries, where many facilities are built specifically to handle Canadian heavy crude. With fuel needs growing and energy prices bouncing around, the US has realized just how important Canadian oil really is. Meanwhile, tensions between the two neighbors are heating up. In March 2025, the US is set to impose a 25% tariff on a wide range of Canadian goods, from food to industrial materials. Canada is ready to fight back with hefty counter tariffs that could affect key products like agriculture, consumer goods, and even cars. There's also talk that Canada might restrict exports of oil and natural gas, a move that could cause American fuel prices to jump even higher. In the end, the situation leaves everyone wondering, can Canada forge a powerful new alliance through canzuk while still keeping its vital relationship with the US? And is the US prepared to risk a full-blown trade clash with its neighbor? With energy supplies and high-tech materials like lithium and cobalt at stake, both countries are carefully weighing their next moves as they navigate these challenging economic times. What if Canada decided to limit its energy exports? US gas prices could jump by 20 to 30% in just a few months. That means not only would filling up your car cost a lot more, but factories and trucks that rely on fuel would face huge price hikes. American businesses might even run out of the materials they need because everything would cost more. And here's another twist. Countries like China and India might swoop in to grab Canada's energy, further weakening the US's hold on its energy supply. Now, think about the big picture. If Washington truly wants to be energy independent, it needs a solid long-term plan. Just slapping on trade tariffs isn't enough. Remember the Keystone XL pipeline? It was once hailed as the magic fix to boost U.S. energy security. Supporters believed it would create thousands of jobs on both sides of the border, secure a steady flow of oil, and even help lower fuel prices. But critics pointed out that the risks, from dangerous oil spills to harming our environment, might be too high. Not to mention, oil from Canada's tar sands releases a lot more greenhouse gases compared to regular oil. With the original developer, TC Energy, stepping away from the project, it's unclear who, if anyone, will pick it up next. So, is the US really serious about bringing Keystone XL back, or is it just trying to put pressure on Canada? Here's another scenario to consider. What if Canada, our closest energy partner, decides to cut off its gas exports? That wouldn't just be a minor hiccup. It could turn into a full-blown energy crisis. Without this critical supply, oil prices could soar, everyday products might cost much more, and even homes in northern states like Michigan or Minnesota could struggle to stay warm during winter. This isn't just a wild idea. It could be real if tensions between the US and Canada don't ease up soon. These tensions didn't start yesterday. They began with aggressive trade policies from past US administrations. High tariffs on items like Canadian steel and aluminum pushed Canada to consider other ways to protect its economy. And Canada's secret weapon? Its energy resources. Canada isn't just a trade partner, it's a lifeline for the US. Over half of the oil imported by the US comes from Canada, and that oil, along with natural gas, electricity, and even nuclear fuel, keeps America's industries running smoothly. From Alberta's vast oil fields and natural gas reserves to the clean hydropower generated in Quebec and Manitoba, Canada has plenty to offer. Cutting off this supply wouldn't just hurt the economy. It could put enormous pressure on political leaders and major companies in the US. In short, Canada's energy resources are a big reason why Washington can't afford to ignore its neighbor. What if one day Canada decided to hold back its oil and gas? Such a move could send shockwaves through North America's energy scene. Think about it like this. If your favorite candy suddenly wasn't available, the price would skyrocket, and everyone would be scrambling to find a substitute. In this case, if Canada cuts off its energy exports, US gas prices might jump 20 to 30% in just a few months. Now, let's take a quick look back. Remember how Russia once used its gas supplies as a tool to pressure Europe? That situation taught us that energy can be a powerful bargaining chip. So, could Canada use its own energy resources in a similar way? If the US keeps pushing tough trade policies, Ottawa might even think about selling its oil and gas to other big buyers like the European Union or China. The real puzzle isn't just whether Canada could do it, it's whether it wants to use this economic power play. Imagine the US suddenly losing a major source of energy. Gas prices could soar, and factories might not get the materials they need. In colder states like New York, Michigan, or Ohio, people might even struggle to heat their homes during harsh winters. This kind of disruption wouldn't only hurt families, it would hit major industries like car manufacturing, steel production, and farming. Leaders from all sides would be scrambling for answers, but by then, it might be too late to stop a full-blown crisis. On the flip side, many Canadians are proud of their independence and strong cultural identity. In places like Alberta, where oil is a big part of the local life, people are already wondering if they could redirect their oil exports to new markets in China or Europe instead of relying on the US. Right now, it seems like a long shot, but with determination and the right investments, Canada might just build the infrastructure to make this a reality. This isn't just about a simple trade shift. It's about Canada taking charge of its own economic destiny. Over the years, tough US trade policies pushed Canada to rethink its strategies. Instead of letting the US call all the shots, Canada has been busy working on major projects in mining, energy, and transportation. They're building new pipelines that bypass U.S. ports, upgrading railways and roads, and even investing billions to speed up trade routes. These changes could help Canada ship its resources directly to Asia and Europe, creating a more independent path for its energy exports. And it doesn't stop there. Canada is also ramping up its renewable energy projects, with solar and wind power growing fast. Plus, as the world shifts towards electric cars, Canada's rich mineral resources, like lithium and cobalt, are becoming more valuable. Big car companies might soon turn to Canadian minerals instead of relying on Asia. If Canada pulls off this plan, the effects could be huge. A stronger, more self-reliant Canada would mean less U.S. control over the region's energy. U.S. tariff policies might not work as well anymore, and other countries might see Canada's example and try to break free from old trade patterns too. What do you think? Could Canada really flip the script and take charge of its energy future? And if it does, will the U.S. have to rethink its own strategies in a new, more balanced North American economy? Please do not forget to subscribe to our channel and activate the notification bell to stay updated with this type of content.